Greetings, ladies and gentlemen, the archivist here. I often say that the best intelligence doesn't come from the mainstream media. It comes from the signal buried in the noise. I read through the comments on our last dossier, and one specific question stopped me in my tracks. A viewer asked something that strikes at the very heart of the global financial war. He asked, "Archivist, how can you claim China is winning the currency war when their own economy is collapsing? Isn't their debt-to-GDP ratio over 300%? It is a fair question. In fact, it is the only question that matters right now. If you read the Wall Street Journal or watch CNN, they will tell you China is a dead man walking. They will show you the footage of ghost cities being demolished. They will show you the Evergrande bankruptcy filings. They will tell you that a country with a 300% debt-to-GDP ratio is mathematically guaranteed to implode. By Western accounting standards, they are right. But here is the uncomfortable truth that Wall Street refuses to tell you. China does not use Western accounting. The West is making a fatal error. They're staring at the liability column, the debt, but they are completely ignoring the asset column. The United States prints debt to fund wars and welfare, money that evaporates into smoke. China prints debt to build dams, ports, and gold vaults, assets that remain for 100 years. Today, I'm going to show you the shadow ledger. I'm going to explain why the China collapse narrative is a psychological operation designed to keep you holding dollars, and why China's debt isn't a bug in their system. It is a weapon. To understand why China hasn't collapsed yet, you have to unlearn everything you know about sovereign debt. In the West, we are terrified of debt because we look at countries like Argentina or Greece. When Argentina gets into trouble, they collapse. Why? Because their debt is external. They owe US dollars to foreign banks in New York. They cannot print US dollars. So when the bill comes due and the vault is empty, the country goes bankrupt. It is a hard default. Now look at China. Yes, the headline number is terrifying. Total debt is nearly 300% of GDP. But ask the forensic question, who do they owe that money to? They don't owe it to JP Morgan. They don't owe it to the IMF. They owe it to themselves. The vast majority of Chinese debt is owed by state-owned enterprises, SOE, to state-owned banks. It is the left hand owing money to the right hand, and both hands are attached to the same body, the Chinese Communist Party, CCP. This is what we call a closed-loop system. In a closed loop, bankruptcy is impossible unless the state decides to allow it. If a massive Chinese railway company can't pay its loan to the Industrial Bank of China, Beijing simply calls the bank and says, "Roll it over, extend the loan for 100 years, change the interest rate to 0%. The debt doesn't vanish, but the event risk vanishes. They can amend and pretend forever because they control the borrower, the lender, the court, and the currency. Unlike the US, where foreign bond vigilantes can sell treasuries and crash the market, China's debt is trapped inside a walled garden. The capital cannot leave, so the system cannot break. But the skeptics will say, "Archivist, debt is still debt. You can't print prosperity. Eventually, the malinvestment kills you." And this brings us to the second massive difference. What did they buy? Let's audit the United States first. Since 2008, the U.S. national debt has exploded. Where did that money go? It went to transfer payments, Social Security, and Medicare. It went to consumption and stimulus checks. It went to military operations in the Middle East. These are consumables. Once the money is spent, the value is gone. The missile blew up. The stimulus check bought a TV that is now in a landfill. We have the debt, but we do not have the asset. Now, let's audit China. When China added $10 trillion to its debt, what did they get? They built 45,000 kilometers of high-speed rail. They built the world's largest 5G grid. They built the Three Gorges Dam. Even the famous ghost cities, the empty apartments you see on 60 Minutes, are assets. Think like an archivist for a second. What is a ghost city? It is millions of tons of steel, concrete, copper, wiring, and glass organized into a structure. In a resource-starved world, that building has intrinsic value. It doesn't matter if nobody lives in it yet. The materials are banked. The copper in those walls is worth more today than when they built it. China has effectively converted its fiat currency, which costs nothing to print, into hard infrastructure, which is finite. Western economists look at a ghost city and see a failed investment because it generates no cash flow. China looks at a ghost city and sees a strategic reserve of urban capacity. They printed paper to extract resources. They won the trade. The reason Western analysts get this wrong is because they are projecting capitalist rules onto a command economy. In the West, if a developer builds a mall and nobody shops there, the developer goes bankrupt. The bank takes a loss. The system shutters. In China, the mall was never about shopping. It was about keeping the steel mill open. It was about keeping the cement factory running. It was about full employment. The profit wasn't cash flow. The profit was social stability and industrial capacity. China deliberately ran up debt to build the factory of the world. Now in 2026, the construction is done. They hold the factory, we hold the paper. If the global financial system resets tomorrow, who is in a stronger position? The nation with a clean balance sheet and crumbling bridges, or the nation with the dirty balance sheet and brand new ports? The debt is just a number on a screen. The bridge is real physics. However, I am not a propagandist for Beijing. I am a realist. While the collapse narrative is overblown, there is one specific part of the Chinese debt that is terrifying. It isn't the sovereign debt. It isn't the corporate debt. It is the LGFV debt, local government financing vehicles. This is the black hole in the Chinese miracle. For 20 years, local mayors in China set up shell companies to borrow money off the books. They use this money to build things that truly are useless. Bridges to nowhere, monuments, empty theme parks. The IMF estimates this hidden debt is roughly $10 trillion. This debt is not generating revenue. The land sales that used to pay for it have collapsed. By any standard definition, the Chinese local banking system is insolvent. There is a $10 trillion hole that cannot be filled by rolling over the loans. The hole is too big. So, we arrive at the climax of the argument. How does China fix a $10 trillion hole without destroying its currency? The West says they have two choices. One, austerity. Stop spending, crash the economy, and suffer a depression. 2. Hyperinflation. Print $10 trillion of new yuan, devalue the currency, and destroy the savings of the middle class. The West is betting on option 2. They are shorting the yuan because they think the printing press is the only way out. They are wrong. China has a third option, a nuclear option, that Western economists have forgotten because they haven't used it since 1934. They aren't going to print money to fill the hole. They're going to reprice their assets. You see, China has been hoarding something else besides concrete and steel, something that sits on the balance sheet of the People's Bank of China at a cost basis of $0, but is actually worth trillions. They are preparing to do exactly what Franklin D. Roosevelt did in 1934 to save the U.S. banking system. They are going to use the golden eraser. In the next section, I'm going to show you the revaluation protocol. I'm going to explain how China plans to use its massive secret gold hoard to mathematically wipe out its bad debt overnight, and why the silver export ban we discussed last week is actually step 1 of this bailout. We established that China's debt is internal. It is a closed loop between the state banks and the state companies. But we also admitted the ugly truth. There is a $10 trillion hole of bad debt, LGFVs, that can never be repaid from cash flow. Western economists look at this hole and say checkmate. China must print money, create hyperinflation, and destroy their currency to fill it. They assume China has to act like the Weimar Republic. But China isn't studying Weimar Germany. They are studying Franklin D. Roosevelt. They're looking at the United States in 1933. Back then, the U.S. was in a similar trap. The banks were insolvent. The debt was unpayable. Deflation was destroying the economy. Did Roosevelt print worthless paper money to bail them out? No. Did he raise taxes on a depression economy? No. He used a trick that most modern economists have conveniently forgotten. He repriced the collateral. On January 31, 1934, FDR signed the Gold Reserve Act. With the stroke of a pen, he changed the official price of gold from $20.67 an ounce to $35 an ounce. Overnight, the value of the gold sitting in the U.S. Treasury's vault increased by 69%. The U.S. government created book profit out of thin air, not by printing debt, but by marking up their assets. They used that revaluation profit, roughly $2.8 billion in 1934 money, to recapitalize the banks and fund the New Deal. They didn't fix the debt by paying it off. They fixed it by making their bank account bigger. China is preparing to do the exact same thing, but to pull off a 1934-style bailout, you need one specific ingredient, a massive pile of gold. And this is where the mainstream media is lying to you. If you go to the World Gold Council website right now, it will tell you that the People's Bank of China holds about 2,235 tons of gold. This number is a joke. It is a rounding error. If China only had 2,000 tons, the revaluation strategy wouldn't work. It wouldn't generate enough equity to fill the $10 trillion hole. But let's look at the forensic math. Let's look at the physical flows that the archivist tracks. 1. Domestic production. China has been the world's #1 gold miner for over a decade. They produce roughly 400 tons a year. Here's the key. Exporting domestic gold is illegal in China. Every single ounce mined in China stays in China. Over the last 20 years, that is 6,000 plus tons of domestic accumulation that never shows up in the official reserves. 2. Import flows. Since 2000, roughly 22,000 tons of gold have physically entered mainland China via the Hong Kong and Shanghai gold exchanges. We have the customs data. We can see the bars crossing the border. They went in and they never came out. When you add the off-books domestic mining to the shadow imports, the real number isn't 2,000 tons. Conservative estimates put the Chinese state reserves between 30,000 and 40,000 tons. Most of this is held by the State Administration of Foreign Exchange, SAFE, or the People's Liberation Army, PLA, not the central bank. They hide it on purpose. They hide it so the West keeps thinking they are broke. Now let's run the numbers. Let's see if the math saves them. Let's assume China holds 30,000 tons of gold. That is roughly 1 billion ounces. At today's manipulated paper price, around $2,600 per ounce, that hoard is worth $2.6 trillion. That helps, but it doesn't cover the $10 trillion debt hole. But what happens if China stops suppressing the price? What happens if Beijing announces a new gold-backed yuan and sets the peg at $20,000 per ounce? Do the math. 1 billion ounces times $20,000 equals $20 trillion. Suddenly, the asset side of China's balance sheet explodes. They have a $17.4 trillion unrealized gain. They can take that equity and write off every single bad loan, every single empty apartment, and every single LGFV debt, and still have a $7 trillion surplus. This is the Great Reset, not the one the World Economic Forum talks about. This is a reset to tangible reality. By revaluing gold, China creates the liquidity to clean up its internal mess without needing to print a single yuan of inflation. The debt is denominated in paper. The assets are denominated in gold. As long as they control the exchange rate between the two, they cannot go bankrupt. They can only revalue. But archivist, you ask, is this just a theory or are they actually doing it? Look at the behavior we discussed in the Asia Flips dossier. Central banks bought gold at record rates in 2024 and 2025. But look how they bought it. They didn't buy it on the futures market. They bought it over the counter, OTC. Goldman Sachs calls these sticky buyers. I call them vault builders. Sticky means price insensitive. It means they are buying at $2,400, at $2,600, at $2,800. Why would a central bank buy at all-time highs? Because they know the real price is $20,000. If you know the asset is going to be revalued 10 times, you don't care if you pay a small premium today. China is frantically scrubbing its balance sheet of U.S. treasuries, paper promises that are about to be defaulted on, and replacing them with hard assets before they pull the trigger. They are effectively insider trading their own policy. So the China collapse is a lie because the debt is internal. The banking crisis is a lie because the gold revaluation fixes it mathematically. But there is one loose end, a massive, dangerous loose end. If China revalues gold to $20,000, what happens to silver? Historically, gold and silver trade at a ratio of 15.1 or 21. Right now, that ratio is near 85.1. If gold goes to $20,000 and the ratio snaps back to its historical norm, silver doesn't just go to $50, it goes to $1,000 an ounce. And here is the problem. Unlike gold, China doesn't just keep silver in a vault to look at it, they consume it, they burn it. They need it for the solar panels, the EVs, and the missiles that power their economy. A gold revaluation creates a silver crisis for Chinese industry. In the next section, I'm going to show you the industrial squeeze. I'm going to explain why China's decision to ban silver exports on Jan 1st was not just a trade war move. It was a desperate attempt to trap the physical metal inside their borders before the monetary reset blows the price to the moon. We discussed the golden eraser. We established that China can mathematically wipe out its $10 trillion debt by revaluing its 30,000 tons of gold to $20,000 an ounce. It is a clean, elegant solution for the state, but for the industrial economy, it is a nightmare because you cannot revalue gold in a vacuum. The entire commodities complex is connected by invisible rubber bands called ratios. The most powerful rubber band in history is the gold to silver ratio. For 5,000 years, this ratio hovered between 12.1 and 15:1. It took 15 ounces of silver to buy 1 ounce of gold. Today, because of paper manipulation on the COMEX, that ratio is stretched to nearly 85.1. Think about the physics of that tension. If China snaps the price of gold to $20,000, the rubber band must snap back. Even if the ratio only goes back to a conservative 20.1, silver doesn't just go to $50. Do the math. $20,000 divided by 20 equals $1,000 per ounce. For a gold investor, that is a windfall. But for the chairman of a Chinese solar panel company, it is a death sentence. He cannot afford to pay $1,000 for the silver paste that goes into his photovoltaic cells. If silver hits $1,000, the entire green energy revolution, which China dominates, grinds to a halt. The cost of an EV battery would triple. The cost of a solar farm would skyrocket. China's manufacturing advantage would evaporate overnight. This brings us to the smoking gun, the event that happened just 14 days ago on January 1st, 2026. We talked about the silver export ban in previous videos. The media told you this was a trade war tactic against the United States. They said China is punishing the US for the chip sanctions. The media is wrong. Beijing doesn't care about punishing the US. They care about surviving the revaluation. They know the monetary reset is coming. They know that once they press the button to revalue gold, the price of silver is going to explode globally. So what did they do before pressing the button? They locked the gate. They implemented an export licensing regime that effectively blocks 99% of domestic silver from leaving the country. This isn't an embargo. It is a ring fence. They are trapping the physical molecules inside China. They are creating a two-tier price. Tier 1, global price. Silver trades at $500 or $1,000 per ounce on the COMEX because there is no supply. Tier 2, domestic price. Silver trades at a subsidized, controlled price inside China for their own factories. They are decoupling their industrial base from the global monetary storm they're about to unleash. They're ensuring that when the dollar collapses, Tesla will have to pay $1,000 for silver, but BYD, the Chinese EV giant, will get it cheap from the state reserves. To understand why they are so terrified of running out, you have to look at the burn rate. Gold is a lazy asset. We dig it up, melt it into a bar, and put it in a dark room. Every ounce of gold ever mined is basically still here. Silver is a working asset. We dig it up, turn it into a paste, put it on a solar panel, and leave it on a roof for 30 years. It is consumed. China installed 216 gigawatts of solar power in 2023 alone. They are targeting even more for 2026. Every single one of those panels requires roughly 20 grams of silver. China's solar industry alone devours roughly 200 million ounces of silver a year. That is 25% of the entire global mine supply consumed by one industry in one country. Now look at the supply side. China produces about 3,300 tons, 100 million ounces of silver a year. Do you see the deficit? They consume 200 million ounces. They mine 100 million ounces. They are structurally short. For the last decade, they filled that gap by importing from Mexico and Peru. But as we discussed, the global supply is drying up, the mines are empty, the grades are falling. China realized that in 2026 there wouldn't be enough silver for everyone, so they decided to make sure there was enough for them. The United States finally woke up to this threat 2 months ago. In November 2025, the USGS, United States Geological Survey, officially added silver to the critical minerals list. This was a historic admission of failure. For 50 years, the US government treated silver as a monetary relic. They sold off their entire strategic stockpile. Now suddenly they realize it is a strategic defense metal. Why? Because you can't build a Tomahawk missile without silver. You can't build a submarine without silver. You can't build an AI data center without silver contacts in the servers. The US military looked at its supply chain and realized, oh my God, we buy our refined silver from China. And China just closed the window. The Jan 1st ban wasn't an isolated event. It was the final move on the chessboard before the checkmate. China has secured the gold to save its banks. China has secured the silver to save its factories. The West has secured paper, so the trap is set. The China collapse is a myth. They have simply restructured their balance sheet from debt to assets. They have ring-fenced the physical metal, and they are waiting for the moment to revalue gold and destroy the US dollar's exorbitant privilege. You are sitting there watching this video, likely holding dollars or euros or maybe some stocks. You're asking, archivist, what do I do? If the reset is coming, how do I survive? You can't buy a Chinese state enterprise. You can't buy a bridge in Shanghai, but you can buy the one asset that China is frantically hoarding. And you can buy it before the revaluation happens. In the final section of this dossier, I'm going to give you the archivist's protocol. I'm going to explain exactly how to position yourself for the revaluation event, why you need to ignore the spot price on your screen, and the specific ratio you need to watch to know when to swap your silver for land. We have walked through the shadow ledger. We've exposed the $10 trillion debt hole. We have revealed the golden eraser, China's plan to revalue gold to $20,000 per ounce to wipe out its insolvency. And we have witnessed the silver ring fence, the Jan 1st export ban designed to trap the industrial molecules before the price explosion. The diagnosis is clear. The game is rigged. China has rigged it to survive. The West has rigged it to pretend everything is fine. But you are stuck in the middle. And right now, millions of you are making a fatal mistake. You're watching this video and thinking, okay, archivist, I get it. I'll buy gold. I'll open my brokerage app and buy GLD. I'll buy SLV. Stop. If you do that, you're walking right into the kill zone. In a revaluation event, the paper market breaks. When China announces the new price of gold is $20,000, do you think the COMEX in New York is going to honor your contract? Do you think JP Morgan is going to write you a check for the difference? No. They will declare a force majeure. They will suspend trading, and they will cash you out at the last traded price, maybe $2,600, while the real price on the street hits $20,000. You'll be left holding a paper receipt for a fortune you will never see. Protocol rule number 1. If you can't hold it, you don't own it. The only way to participate in a Chinese-led revaluation is to hold the asset outside the banking system. You need coins in a private safe. You need bars in a non-bank vault. You need to be your own central bank because when the reset happens, the counterparty risk goes to 100%. The exchange is the enemy. Now let's talk about the specific trade. Many of you ask, should I buy gold or silver? The answer depends on your goal. Gold is for preservation. It is the shield. It ensures that when the dollar dies, you don't starve. Silver is for speculation. It is the sword. Here is the archivist's ratio protocol. Right now, the gold to silver ratio is hovering near 85.1. It takes 85 ounces of silver to buy 1 ounce of gold. This is historically absurd. It is a sign of extreme manipulation. But when the revaluation hits and the industrial squeeze we discussed in Section 3 kicks in, that rubber band will snap. History tells us it will overshoot. It won't just go to 15.1, it might go to 10.1 or even 8.1 like it did in 1980. The strategy: 1. Accumulate silver now. Buy it while it is cheap and unloved. Buy it while the ratio is 85.1. 2. Wait for the snap. Watch the ratio, not the dollar price. Ignore the noise. 3. The exit. When the ratio hits 20.1 or lower, you do not sell for dollars. You swap. You trade your silver, which has appreciated 10 times, for income-producing assets. You trade the silver for farmland. You trade it for rental real estate. You trade it for a business. This is how dynasties are built. You buy the undervalued asset, silver, wait for the revaluation, and then flip it into the forever asset, land, right at the peak of the mania. You're effectively using China's squeeze to buy your neighborhood for pennies on the dollar. But archivist, I hear the gamblers asking, what about the mining stocks? Won't they go up 100 times? Maybe. But remember the geopolitical reality we are discussing. We are talking about a currency war. If gold goes to $20,000, gold mines become strategic national assets. Do you think the government of Peru or Mexico or Tanzania is going to let a Canadian company keep all that profit? No. They will impose windfall taxes. They will nationalize the mines. They will change the royalty structure. Look at what Panama did to First Quantum. They just took the mine. Look at what Mexico is doing with its open pit ban. Protocol rule number 2. Jurisdiction is everything. If you play the miners, you must stay in the safe zones. You want mines in Nevada, Western Australia, or Saskatchewan, places where the rule of law might still exist when the panic starts. Buying a junior miner in a shaky jurisdiction right now isn't investing. It is donating your capital to a foreign warlord. Be very, very careful with the leverage play. The physical metal has zero political risk. The miner has 100%. So how will you know when the revaluation is starting? They won't announce it on the news. CNN won't tell you China is revaluing gold tomorrow. You have to watch the ghost signal. Watch the Shanghai premium. Normally gold trades at the same price in London, New York, and Shanghai. Arbitrage keeps it level. But recently we have seen the Shanghai premium blow out to $40, $50, sometimes $80 over spot. This is the crack in the dam. It means physical metal is draining out of the West and flowing east. When you see that premium spike to $200 or $300, the game is over. That is the moment the paper market in New York has officially decoupled from the physical market in China. At that point, the spot price on your screen is a lie. The real price is whatever the Chinese are paying. Don't wait for the official announcement. The premium is the announcement. Let's summarize the dossier. The media tells you China is collapsing because of a 300% debt-to-GDP ratio. We have proven this is a mathematical illusion. Their debt is internal, owed to themselves. Their assets are real infrastructure and gold, and they have the golden eraser, revaluation, ready to wipe the slate clean whenever they choose. The United States has external debt owed to foreigners. Our assets are paper derivatives, and we sold our strategic gold reserves decades ago. China isn't trapped. We are. They are currently ring-fencing their economy, hoarding gold, banning silver exports, and stockpiling copper because they know the storm is coming. They are preparing the lifeboat. Meanwhile, Western investors are rearranging the deck chairs on the Titanic, arguing about whether Nvidia will hit $200. You cannot save the system. The math is too broken, but you can save yourself. You can follow the archivist's protocol. Get out of the paper. Get into the physical. Watch the ratio. The collapse is coming, but it isn't going to happen in Beijing. It is going to happen in your wallet unless you move first. This is Archivist. The protocol is active. Class dismissed.